Hello, everybody. Welcome to the Carter Tomac Show. This is episode number 1, and I've been talking about this for 5 years, and I'm just going to do it. I'm just going to go for it. In today's episode, we're going to talk about business lending. I'm a commercial loan officer currently. I have been for the past 5 years, and so I work with this stuff every day. I get a lot of people in my office, a ton of people that come in and they just don't know what they're doing as far as getting a loan. They don't understand what banks look for. They don't really understand really anything. They don't understand what a balance sheet is. They've never done a cash flow. They don't even really understand how they file tax returns. So I figured that'd be a good first kind of topic. And so we're going to specifically today, we're going to talk about business lending. We're not going to be talking about, getting a mortgage, consumer loan, stuff like that. This is going to be helpful, I think, for business people, especially startup businesses who are like, hey, I did my LLC. Yeah, I've got some revenue coming in, but, it's 10 grand a year. And the bank just denied me. Why? Why did they deny me? So this is going to be helpful, I think, for everybody, including big companies. Sometimes it's helpful to, figure out what the person on the other side of the room is looking at, and what they're assessing. So what I'd like to do is I'd like to maybe just kind of get into it. So I've shared my screen here. By the way, shout out to Riverside, who I'm making this episode of the podcast with. This is very simple and easy to use, and I can kind of do it on my own, and I kind of like that. We'll start with the 5 C's of credit. The 5 C's of credit are important in business lending. They're really important in all lending, but they're especially important in business lending. So I have here, I Googled it, and we'll just go kind of one by one, but character. So when somebody comes into my office, what am I looking for? Well, can I trust this person? Are they going to pay me back? Because if I make a loan to somebody and they don't pay me back, that doesn't look good on me, especially if I lose the bank money or I lose the credit union money. So character is basically your credit history, your reputation for repaying debt. Lenders review your credit score and report to see how reliably you pay your bills, right? So that's character. Pretty straightforward there. Capacity then is like your ability to repay the loan. Do you make enough money to repay the monthly payments? That is the 1,000-year-old question in banking, or 500, or what, however long banks have existed. Does this person make enough money that they can afford the monthly payment on top of like buying food and fuel and just personal expenses? Okay, so we're looking at your capacity and how we measure that as a guarantor of a business, and I guess maybe I should explain that real quick. So like an LLC, if I have an LLC, all right, XYZ LLC, I'm the sole member of the LLC, so I'm the only owner. I go into the bank and apply for a loan. I am then considered the guarantor. Not a lot of lenders, especially for startup businesses, are going to, just give the business a loan based on the business's financials, because startups either they don't have financials or they just don't make enough. Okay. And we'll go through that a little bit later in this video too. So anyway, there, a little side note caveat there. But capacity then measures what's called a debt to income ratio. Okay. And some of you might probably are familiar with this. But basically how much money's coming in, how much money's going out. And we can kind of get into that a little bit later. There's also under capacity, especially in the business realm. What a lot of banks are going to look at is specifically, can the business service the debt? And that is debt service coverage ratio, which is a different metric, but it's kind of the same as DTI. And we'll go through that a little bit later in the video too. Capital then is like, how much money are you going to invest? So do you have enough liquidity to do that? I might verify your liquidity. I might ask for bank statements. I might do really anything like that. And that's just to verify number 3, which is capital. So number 4 then is collateral. And, how much are you putting down? I know that's kind of under capital too, but how much are you putting down? What assets are you going to offer to secure the loan, basically? Okay. Number 5 is conditions. Is there any, in banking, we call these covenants, like hey, you're required to give me, and this will go right in the contract. If you read the fine print of the business loan agreement when you sign loan docs, it will say in the agreement that, I want to collect annual financial statements on the business if it files a separated tax return, and you or me as the guarantor. Okay, so you're going to have a lot of the times, well, some of the times, I mean, you can file like as a Schedule C on your personal tax return for business income. Okay, a lot of people do that. Very common. But there's another way you can do it where you can, file a separate, basically corporate tax return that just is assessing the business. So you might have one tax return or you might have two. So in the business loan agreement, you'll have things like, hey, I want you to provide me financials every year because I have to do an annual review based on the size of your loan. Like I've done $1 million loans before. Most of them are on an annual review basis. What we're looking for is, has anything changed in any of these 5 C's of credit? Every year, we're going to do that for business lending. If you go out and get a mortgage, it's very unlikely that anybody's going to do an annual review on you. But when you own a business, is a bit different, okay? So, we've kind of covered the 5 C's of credit here. This is actually a really good starting point for business lending, okay? I think now we'll dive into DTI. That's a little bit of a more simple calculation. DTI is basically on a guarantor, your personal, like when you go to get a mortgage, they're going to look at your DTI, okay? It's a personal finance measure that compares your total monthly debt payments to your gross monthly income, okay? Now, keep in mind, gross versus net, right? There's a big difference there. Net is your take-home pay from your W-2. Gross then is gross. I mean, it's you make $10,000 a month, okay? But your take-home is only $7,500 after taxes. So gross then is before taxes, excuse me. So that it's kind of simple. I mean, what goes into DTI? Well, a lot of different things. So rent would, if you have a car payment, it would. Credit cards, generally speaking, would. A lot of different things. What doesn't go into DTI? Well, food expenses, utility costs, fuel, stuff like that. And so this is a very important metric because every single bank in credit union that I know of in this country uses DTI for personal finance. Okay? Very important. So it says like down here, good versus bad, like a lower DTI indicates a healthier balance between debt and income. Okay? I don't care who you talk to. probably 5% of people have debt in some capacity. What's interesting to me is when I walk around the streets of Arizona and or I'm in my office and I talk to people, they're like, well, I have $100,000 in debt. And I'm like, okay, well, like, do you have a house? Like, do you have a mortgage? And they're like, yeah. Okay, what's your mortgage? Well, $250,000. Okay, well, no, you have more debt than that. Debt is everything that you owe. Okay? I don't know really why people get that confused, I guess, but they do. Okay, so that's a little asterisk side note there. So DTI, sorry, not done here yet. DTI is, we're going to assess that for a business loan because we want to make sure that, like, if the business can't repay its debt, that we have a secondary source of repayment. We want to make sure that the money can come from somewhere. So, like, we're going to take a look at, okay, you started this business. Are you going to keep your job? That might be a question that I ask you when you come into my office. And the reason why I'm asking that is because I want to make sure that you're able to afford the payment for the startup business or an existing business, even if the business can't cash flow its debt. All right. So if you have a job and you make $100,000 a year on the side and you have $36,000 in debt payments annually, your DTI is 36%. It depends on the loan. Like for a mortgage, they might only go like 43% DTI, depending on the program. I'm not really qualified to talk about that. But like what I look at is basically our hard cap where I work right now is 50%. If it's over 50%, the business better be making money. Okay. If it's under 50%, like if it's 10% and the guy wants or the gal or whoever wants a $50,000 business loan with a payment of $1,000 a month and he's making $100,000 a year, I might just literally take that payment and plug it into his DTI and not even worry about the business's cash flow. Okay. So there's a lot of, does that make sense? And if it doesn't, I can answer some questions in the comments or however this is going to go. But I hope that makes sense for you. So let's move on to, so debt service coverage ratio is a little different metric. So it's net operating income, and this is net. Okay. Keep in mind, it's not gross. I don't even think there is such thing as gross operating income. Maybe there is. Well, it's sales, I guess. However, okay, so it's net. All right. So net divided by total debt service. So the business owes annually $100,000 in payments, but it makes $1 million a year. Net. Okay. So we're going to take $1 million divided by 100,000. That's going to give us our debt service coverage ratio, which is 10 to 1. Okay. Well, it's 10. Let's do a different example here. So if a business made $100,000 a year in net operating income, why don't we do this? Let's take a rental property. Okay. So, because this is I see this all the time. I mean, people have rental properties like you wouldn't believe. They're just everywhere. And generally speaking, they're good loans too. But that's a side note, and we might get to that later. So net operating income of like a rental property. So you have $1,000 coming in a month from rent, and they pay on time. You don't have to worry about it. Okay. So that's $12,000 a year. Now you have a commercial mortgage that you're paying $10,000 a year on. So 12,000 divided by 10,000 is 1.2. Right. What this means is like you are making $1.20 for every dollar that you owe the bank. You're basically just paying the mortgage with the rent that you're receiving. Okay. So that's debt service coverage ratio. The next thing we're looking at, another ratio, is like loan to value. Okay. So you want to buy a $100,000 property to put your mechanic shop in or something. What you're going to do is you're going to go to the bank and you're going to say, hey, I need a loan for $100,000. Okay. And the banker's like, okay, well, what are you going to do with it? What are you doing? Are you buying real estate? How is that going to help your business? He's going to ask you a ton of questions, not for the point of like pissing you off or annoying you, but because he wants to know you, because this is a relationship-based business and he wants to build that relationship with you, because in 5 years, you might want to expand that business and buy another mechanic shop. And so now you know who to call. Well, your banker, right? So it's heavily relationship based, and that's why we're asking those questions. But back to loan to value. So borrower has $20,000 down on a $100,000 building, right? So I'm assessing the 5 C's of credit: character, capacity, collateral, conditions, and the other one. I know I should know this, and that's kind of embarrassing, but we're gonna roll with it. I'm assessing all that stuff, but I'm also assessing like the value of the collateral. Okay, so we're going to generally get an appraisal, and the appraisal is going to come in at, let's just say the appraisal comes in at the purchase price, $100,000. Okay. So he's got $20,000 down. He's going to give me that money, and I'm going to finance the rest. I'm going to finance the $80,000. So our loan to value would then be 80%, because if he defaults, me as the banker, I've got to take it back. I've got to foreclose. I'm going to have expenses. So I want to make sure that I have enough cushion in there that like if he just never makes one payment, that I can at least get some of my money back. So that's loan to value. Again, if you have any questions, you can drop them in the comments or whatever. I'm kind of realizing that this episode could be 4 hours long. And so what I might do is I might make another episode later on that kind of gets deeper into this stuff. But I think for the first one, this is a good place to stop. I think this gives enough information. I plan on offering valuable information in the future that you might not know. And this isn't just going to be like a business lending podcast. It's going to be a lot of different things. Okay. But I just wanted to start with what I know how to talk about. Because I just, there's so many people that they just come into my office. They have no idea what they're doing. They don't understand anything. And that's not derogatory. It's just that nobody ever like taught them, or they didn't have time to teach themselves. Okay. So thank you for listening to the first episode here of the Carter Tomac Show. I'm going to try to do some follow-up videos about this stuff specifically, and we'll kind of run it as the same format as we did today. And I appreciate you listening. Please like, subscribe, and comment if you have any questions, comments, concerns. Thank you very much.